Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us at the MarketSite studio of Michael Normyle, U.S. economist at Nasdaq, to discuss why the expectation for a Fed to pull off a soft landing has become the dominant narrative over recession and what risks are to that thesis. Michael, it's great to see you as always. Welcome back to Trade Talks, and let's talk about that. It feels as if the markets are coming to term around a soft landing. Why do you think that is?
I think it's really just the resilience that we've seen in the economy over the last couple quarters, and Q3 is off to a much stronger start than people expected. I know we're coming to the end of Q3 in terms of the calendar, but in terms of the data, we're still getting July, August data. So it's been a lot stronger than expected. So we're looking, maybe a 3% GDP print is possible in Q3, 2 to 3%, somewhere around there. And I think that's a lot stronger than people were expecting, on top of the labor market continuing to hold up through this point of the year so far. So I think there's just been a lot more positives than people were expecting.
And despite the positives that we see, Goldman Sachs is calling out 3 key risks that could impact this thesis.
Right, and so the first big one is, of course, is the restart of student loans, and that's October 1st, where 43 million Americans have to find between $200 and $300 a month on average for their student loan payments again. And so about 2/3 of that is expected to come from reduced spending, with the other third coming from reduced savings. And because of that, it should take about half a percentage point off Q4 GDP growth. And so the other thing that we're looking at, of course, also October 1st, would be the federal government shutting down. And so that typically is estimated to be about a 0.2 percentage point drag on the economy per week. So we're looking at estimates right now are about a 2-week shutdown. Of course, it could be more, it could be less. And that's really the driver of that is reduced federal spending, of course. So the discretionary spending is what's really impacted there, and that's about 25% of federal spending. So that would pretty much drop to 0 in a full shutdown scenario. The good news is, after the government reopens, much of the loss that we see from reduced spending, there's catch-up spending, so a lot of it gets reversed. And then, of course, the third shock that we've had to the economy lately here is the ongoing UAW auto workers strikes. And so right now that's impacting Q3 GDP. If it continues into October, that's where it will start impacting Q4 GDP. And so it's about 0.1 percentage point drag on growth per week. And the question is really, how long will it go on? And over the last few decades, we've seen strikes as short as three days. We're beyond that point now, or as long as 54 days. So it's a pretty wide range that we could see for that. So the government shutdown and the UAW are something that could end at any moment, in a sense, if the government passes a full year spending bill or even a short-term spending bill, and if the auto union and the automakers are able to come to a deal. So the only one that's guaranteed to impact Q4 GDP is the student loan payments, but the rest remains to be seen. I think for now, though, we're looking at a scenario where Q4 GDP, even with these headwinds, as long as the shutdown's not too long and the auto workers strike isn't too long either, should still be at least avoiding a contraction, if not positives.
Right. Well, when you think about it, though, with the strike, the longer it goes on, and even depending what they are able to negotiate, that's going to be more cost for the auto companies. Where do you think that cost is going to trickle down to, right?
Right.
So it feels as if it's going to impact the consumer in one way or another, regardless of how fast they resolve this.
Yeah, I think that's right. We've all been dealing with auto prices going up, whether you're in the used car market or the new car market over the last few years. So this is just another thing that might be pushing up car prices.
All right, Michael, appreciate the insight as always. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, global markets reporter at Nasdaq.